All right. Well, hi, everyone. I'm Travis Wesley. I'm a certified financial planner and investment advisor representative here at Financial Investment Team. I specialize in working with families, professionals, and business owners to align their financial lives with their goals. So, whether that's retiring with confidence, managing concentrated stock positions, or planning generational wealth strategies. At FIT, I focus on integrating financial planning, tax efficient investing, and business succession strategies for business owners and setting up or managing qualified retirement plans such as 401ks and cash balance plans. Today's town hall is about helping you guys navigate through economic uncertainty. So, from market volatility and inflation to global headlines like tariffs and geopolitical risks, we're going to take a step back and review what matters for long term investors. So, this is especially important whether you're still accumulating wealth, nearing retirement, or already relying on your portfolio for income. So, the theme today is disciplined investing through uncertain times. So, this quote from Benjamin Graham, father of value investing, reminds us that investing isn't a competition, it's a long term commitment to your goals. At FIT, our focus isn't chasing market outperformance each quarter, month, week, or day. It's making sure your plan reflects your values, supports your needs, and adapts as your life changes. And true success comes from consistency, patience, and staying aligned with your purpose. So, our approach is built on a repeatable and personalized process. We start with a discovery phase, which is your values, goals, fears, and timeline. And from there, we take a deep dive into your financial position. So that's your income, assets, liabilities, and tax situation. Once we understand where you are and where you want to go, we develop a strategy. Then we implement, track, and adjust. And so the plan evolves with your life and remains centered around you. So life obviously is full of competing goals. Depending on what life stage or decade you're in, it can look very different for you. So maybe you're paying off a mortgage, funding college, or helping aging parents, all while saving for retirement and balancing your own career and personal goals. So as CFPs, we take all of this into account to craft a strategy that helps you prioritize and stay organized. And that's what we mean by all of life planning. So market volatility isn't just noise, it's a part of the process. Now, over time, the ups and downs can benefit disciplined investors through rebalancing and long-term opportunity capture. So for those of you close to retirement or already taking withdrawals, the same volatility can disrupt cash flow if the plan isn't structured appropriately. And that's why we differentiate risk management depending on your stage in life. Obviously, setbacks happen, whether that's a market event, personal emergency, or global disruption. And that's why we incorporate contingency planning into your strategy. So, emergency reserves, insurance protection, and stress tested withdrawal strategies to create resilience. So, we prepare, not predict, so that you're positioned to endure short-term challenges while staying focused on your long-term outcomes. When investors act out of fear or greed, they usually hurt their long-term outcomes. Instead, as wealth planners, we rely on structured rebalancing and goal-focused allocations. And we're not reacting, we're responding based on your plan. So in a year like this, with geopolitical stress and interest rate uncertainty, the discipline is more important than ever. Planning is more than just investments. So as you look at this wheel, it includes cash flow management, insurance reviews, tax planning and estate strategy, employee benefit analysis, and so much more. These components have to align. For example, tax efficient withdrawals in retirement might reduce your tax liability by tens or hundreds of thousands of dollars over time, but only if coordinated in the overall plan. So we begin every relationship by asking, what are you trying to accomplish? Retirement by a certain age, travel, supporting family. Once these goals are clearly defined and quantified, we can reverse engineer the strategies and benchmarks that align with your vision for success. Investor behavior is a powerful driver of outcomes, and staying invested, avoiding fear-based decisions, sticking to your plan really matters more than choosing the top performing stock or bond. And we provide the behavioral guardrails to help you make smart decisions consistently, especially when emotions are running high. No two clients are the same, and we incorporate your income streams, business ownership, stock compensation, family dynamics, and risk preferences to tailor your strategy. The planning has to fit the person, not just the portfolio. Now, people often think that their financial goals are fixed, but the truth is that goals evolve. So we see this all the time. Clients start to focus on retirement, they shift to helping grandkids through college or starting a new venture or a charitable legacy. And sometimes they just simply want more flexibility, traveling, moving closer to family, or even just semi-retiring. That's why we routinely review a checklist of potential goals. So because clarity increases when you're presented with the options, as you look at this chart, your goals might not change annually, but how you prioritize them can, and that can and that shift has direct implications on asset allocation, time horizon, so the length that you're investing, and even perceived risk tolerance. So, for example, if you think about the last 10 years, where you lived, what you earned, how you spent, odds are a lot changed. Now you think ahead to the next 10 from now. When we build financial plans, we're not just anchoring decisions to today. We're projecting forward, considering longevity, family transitions, market cycles. We're not just trying to be fortune tellers, but we're preparing you for the types of financial questions that often surface later in life. When should I downsize? Can I afford to help my kids buy a home? Is long-term care going to affect my spouse or my retirement? Planning the horizon means building a plan flexible enough to evolve as your life does. So diversification today is more than stocks and bonds. It includes alternative strategies that behave differently during stress events. That might mean increasing allocations away from US stocks, finding opportunity where there's less noise, or real estate for inflation resilience. Diversifying differently also means recognizing that not all risk is rewarded equally. Some risks are simply unrewarded volatility, and our job is to distinguish the difference and adjust accordingly. So, especially in today's landscape, where rates, inflation, and geopolitics are pushing on asset classes in ways that we haven't seen in generations or sometimes people's lifetimes, it's critical to own a portfolio that isn't overly reliant on a single outcome. Now, one of the most important services we offer is helping investors manage through uncertainty, not avoid it, but prepare for it. And that means building portfolios that are structured to withstand the inevitable bumps in the market while keeping your long-term trajectory intact. A lot of clients tell me, I just don't want to feel like I'm on a roller coaster anymore. So we aim to provide a smoother profile, not just by eliminating risk entirely, but by using tools like income sleeves, options for hedging, and diversified sources of return. So it's not just about constantly adjusting your portfolio, it's about building the one that adjusts with the world. So it's important to reframe also how you measure success. Market benchmarks are useful references, but they don't tell you whether you're on track for your goals or not. A year with negative performance can still be a win if your plan anticipated it and your spending or income needs were met without disruption. So we focus on your benchmark, whether that's retiring at 62 or buying a second home in 5 years or maintaining purchasing power over 30 years in retirement. And that also brings us to inflation. It may not make headlines every day, or maybe it does, but it quietly compounds over time. And in global economic pressures like tariffs and supply chain disruption and the cost of living, it can escalate quickly. Our planning accounts for this by prioritizing assets with growth and resilience, dividend-paying equities, inflation-linked bonds, and alternative assets that preserve value across the different cycles. So if your plan assumes just flat prices, it's already out of date. And we build for inflation from day one so you aren't caught off guard when purchasing power starts to slip. Now, there's no substitute for discipline. In a world driven by headlines, meme stocks, and AI hype, it's easy to get distracted by short-term noise. But our process is grounded in valuation and quality, and we don't chase trends. So we evaluate whether an investment offers a reasonable return for the risk being taken. And I say Diana and Chris, that could mean buying what's unpopular but undervalued or trimming positions that have outpaced their fundamentals. So long-term results come from long-term thinking and staying true to your plan, even when it feels uncomfortable in the moment. Now, every portfolio we build starts with a question. What is the purpose of this money? Once that's clear, we design based on 3 steps. First, we match the portfolio to a timeline and withdrawal needs, whether that's 5 years or 25. Second, build an allocation using asset classes that play complementary roles. So growth, income, liquidity, or inflation protection. And third, we evaluate not based on arbitrary indexes like the S&P or the NASDAQ or MSCI, EFA, but on whether the portfolio supports your life. So a 6% return might beat a benchmark, but it still falls short if you needed a 7% for your goals. So the objective really drives the design. Now, this quote underscores what we try to build here. Frameworks that hold up when emotions run high, having a sound decision-making process, grounded in your plan and supported by a team that understands your needs. And it's what allows you to act with confidence and not react with panic. I'm sure some of you may have been calling in or sent an email just wanting to know how are things going. But you don't need an expert in markets to be successful. You need to trust the process or a process in general, stay consistent, and allow your strategy to compound over time. And that's what we're here to help you do. So whether you're 25 years from retirement or already drawing income, our approach flexes with you. So today's market conditions, tariff talks, inflation, volatility, they're going to impact your sentiment, but they don't change your long-term plan. We're here watching the markets so you don't have to react to every headline, tweet, or water cooler conversation about the economy. And so we want to help you keep your plan working in the background so you can keep living your life. We're always here to review, reevaluate, and realign your plan. So on behalf of the staff and the advisors here at FIT, we want to thank you for your trust and continue building financial future that reflects your values and vision. And so at this time, I'd be happy to take questions, any questions that are sent to Carrie. Go ahead.
Each account is reviewed against the investor's particular goals and the current situation on a monthly basis. Is that correct?
So yes, there's kind of 2 parts to that. Some of the first part would be that our portfolio team, so that includes Diana and Chris, are meeting with us at least on a monthly basis to give us updates on what's happening in the economy. How does that align? Because we're the financial planners are looking at everyone's goals, and so you should be logging in, at least a couple times a year. We would love it if you did it quarterly. Um, but we're looking at that to see that you're on track. And so if you meet with us maybe quarterly, semi-annually or annually, a lot can happen in those periods of time. And like I said, yeah, we are looking at those things. And a month might come maybe recently where we saw a big fluctuation. But if you go back and we just met recently, we take into account things like the Monte Carlo simulation where we talk about probability. And that's the stress testing where, we're still accounting for situations where the market could outperform. We typically take a more conservative approach and say, what is the worst case scenario that we can help make sure that you're on track? So it's not just about the investments, although it's important. It is a piece of the puzzle, and we do regularly monitor and check as well. That's why we encourage to make sure that we're having ongoing meetings with people. I hope that answers your question, Eric and Alyssa.
Travis, I have another
Yes, thank
question. Oh, I'm sorry, Eric.
I was just saying thank you.
Okay. If you want to ask anything else, you can feel free to unmute yourself again. Travis, there's a question here that says, we have heard in the news that some countries are threatening to refuse to use US bonds. Won't this threaten the US dollar as a reserve currency? What is a strategy to account for this?
I can't say this with as much confidence, but I can say that we're not going to be going to the Chinese yuan or Russian, what are they, rubles? I don't know what they are, but we're not going to be going away from US currency anytime soon. Gold is still not something that we can use as a reserve. So the concern that it's we've seen some unloading of US bonds. That's a headline. Again, those things have been happening already for years, well before this maybe recent headlines. So it's another way for people to get distracted and listen to news pundits. But I can tell you that the fixed income as a part of the portfolios are still very much strong pieces of the portfolio to provide stability and income. And um, if you if Diana wanted to chime in, she would say, feel free, Diana, if you're there still. But a lot of the bonds that we have are pretty short term, and as well we've been purchasing more CDs, certificates of deposit they're very short term. So
So,
Diana, did you want to say something?
yeah, am I unmuted?
You can be heard. Yeah.
Okay. So, no, I don't think that the US currency is going away, and I don't, it certainly won't go away for the US. It may not be as strong a global currency as it once was, but it's not going away for the US. But as far as bonds are concerned, so we started buying bonds in the fall of 2021. We were buying 1 year bonds because we could get a really good 5.3% interest. And then as we've moved through this transition phase, it would appear, despite all the rhetoric, that we're probably going to have inflation, and we're probably going to see Jay Powell, as long as he is the one in office, raise interest rates at some point. So starting about 5 months ago, we started buying, instead of 1-year bonds or 9-month bonds, we started buying 3-month bonds and 6-month bonds. So that as interest goes up, and I'm pretty sure that it will, we will have the opportunity to reinvest that money as it matures into higher interest rates bonds. The highest interest rate bond out there today is the US Treasury. It's higher than, unless we get junk bonds, of course, but if I'm buying equal quality bonds, corporate bonds are paying about 2 or 3, 2/10, 3/10 less than the US Treasury bonds. And we'll continue to buy those US Treasury bonds, and we'll continue to use short-term investing, unless if the rates bop up so that I can get 5% instead of 4.3, then certainly we will be buying longer-term bonds. Probably 1-year bonds, since I don't think that we'll see a 2-year bond higher than a 1-year bond at this point. So, and what that does is it adds stability, it adds surety. Now, the reason that the bond market has been questionable as far as just straight bond buying is that the rest of the world owns a lot of our treasuries. China is a huge buyer of US treasuries, and as is Japan, most of Europe. And when Mr. Trump started putting in his tariffs, one of the things that the foreign countries have said is, you know what, we're just going to sell your bonds back to you. And we're just going to make you have to print money and devalue your dollar, so that you're going to have less buying power with your high tariffs and our high tariffs in return. So that's what's actually happening. China has recalled many millions of dollars, billions of dollars of bonds, as has Europe, as has Canada and Australia in retaliation. So there's a lot of things going on behind the scenes besides just tariffs that are running and causing the markets to go up and down depending upon what's being said.
Travis, are you ready for another question?
Yeah, go ahead.
Is it wise to put some funds in markets or banking outside of the US right now?
So I think that sounds like a two-part question. So is it wise to put it in the markets or outside of the US? Meaning just put, I guess you'd have to deal with currency exchange there. So from a financial, so just to reiterate, this is about my presentation today is really focused on the financial planning discipline element with investing. And so one of the things that I talked about was how it's really tied to your goals. So, and we're not trying to predict anything. Diana's not sitting around wondering, like, okay, now let's get in. We're obviously looking every day. We have these conversations literally every day. But you can say dollar cost averaging. These people who are kind of forced to continue to invest, that's a great option for them. But whether you have $1 million today, or a week down the road, we have no idea what's going to happen. We're not thinking that it's a terrible time to invest. I think it's always a good time to invest. And we can be wrong, but we can be right. So I think that the most important thing is having a strategy in place. So if you have cash on the sidelines, for example, more than what your needs are. And if that might also, you have to review, like, is my emergency fund good? Am I still working? Um, do I have all these other things as a part of that puzzle? I'm going to go back a few screens. So the investments are really just a slice of the pie. And there could be another piece of the puzzle that we're missing from that question. You know, if the markets are down or if your account values are down, do you have the ability to do a Roth conversion? You could do an in-kind transfer from your pre-tax IRA or 401k into Roth IRA now that prices have lowered a little bit. And for you, well, now you own the same amount of units, but you're going to transfer those over, take advantage of lower prices without changing anything fundamentally in your portfolio. And risk management is another thing. Do you have the appropriate amount of cash on the sidelines? Well, maybe this is a good opportunity to buy some, or just have like a money market account that can be at Marcus or Schwab or wherever. And hopefully, we're starting to see a lot of these rates come down at banks. I get emails often that, oh, instead of 3.75, now it's 3.25. So Diana's done, an incredible job of finding opportunities for us to still get some good yield with where everything's at. And that's important. As I talked about inflation, that's one of the things that's going to erode the value of your money as prices keep going up. You have to have that balance, not just of equities and cash and bonds. It's knowing what your goal and your time horizon is. So as far as like investing outside of the United States, I'm a dual citizen, so I'm not running to Canada to put any money there. Um, I don't really have much to say about that. But in that regard, you're really playing to currency investing. And Diane, I saw you came off mute if you want to say something on that.
I was just gonna say, so we started a couple months ago and are slowly moving, slowly in that within 6 months, we'll have all portfolios that are over 250,000 at a minimum of 10% of companies that are outside the US totally, moving to 20%. Things continue on, we'll probably move to 30%. I've identified about 80 companies that are really good, strong companies, some in Europe, some in Asia, some in the UK, some in Africa, some in South America, some in Latin America, that don't rely on the US for anything. At a first level. Now, obviously, if there's a recession, there is some issues, but companies that should be able to function whether there are tariffs or no tariffs. And so to move money outside the US, that's what we're doing. Is we're not actually buying in foreign markets, but we're buying foreign stocks in the US market.
Market. Okay.
Travis, can I go ahead with another question?
Yeah, I also saw one in the main chat too.
Yeah, so there's a question about, is there a way to forecast when we can withdraw a significant amount for a large purchase? We are in retirement and I don't want to decimate our portfolio.
Yes, with the caveat. So I'm going to tie this in with that other question in the chat about Monte Carlo. So Monte Carlo is a part of the financial planning process that might be new to some people, but what it does is it's not a card game. It's not It's not something we're doing at the casino. Monte Carlo takes 1,000 different iterations of your plan, back testing it and putting it through different scenarios where there's high inflation, higher spending, um, longer lifespan, um, things that just aren't working out in the portfolio. And it does this 1,000 times with what you're currently doing. Maybe you save less. What that does, but it's putting in what you're kind of statically doing now. We build in these scenarios off of what you're currently doing and do these alternative scenarios to say, we want to have a level of certainty that even if you did this and reduced your portfolio size by X amount of dollars, that you would still be on track. And we typically want to see you somewhere close to around 80%. What that means is, and we are using sometimes 90 or age 95 as your life expectancy. It's all depending on different people, but I'm using that as a standard. We're hoping that people will live that long. And it's also based on actuarial numbers and back tested numbers. People are just living longer. Some people are living just into their 60s and 70s. And at the same time, we don't want people to have this huge treasure chest of money left over that they weren't able to spend and live in their kind of go-go years. So if you think of it as your go-go years, your slow-go years, and your no-go years, you still need the ability to live life and do these things you want to do. Again, we're not soothsayers. We have no idea what in 10 years everything's going to look like perfectly, but we can still plan and give you protection and guardrails to allow you to do that. So maybe that's carving out a piece of the portfolio now. Maybe you have pensions. Maybe you have a property you're planning to sell. Maybe there's a way that you, in certain years, are not spending as much. We have a lot of tools at our disposal to help you integrate some of these goals and plans in a reasonable way, and without providing guarantees, but still giving you a level of certainty and saying like, okay, this is going to get me. So when I say that 80% success rate or probability of success, that means 80% of the time it's going to work no problem, and 20% of the time maybe there's just a small adjustment that you're going to have to make, or you can't go on that $15,000 vacation that year, or whatever it is, or funding kids education. So there's lots of different components, and I know I don't want to oversimplify or make it too complex at the same time, but there are just so many elements. It's really not just the investing. We want to help you guys visualize that at your next meeting. Ask your planner and how we can show you if there's some kind of strategy or goal that you're trying to accomplish that's different from what your base case was.
There's no other questions in the queue, Travis.
All right. Well, if anyone has any other questions that come up or you thought about that you took away from this, we invite you to send them in, schedule some time with your advisor if you haven't met with them, and talk about your financial plan. If there's someone who who's really struggling with all this, we're always happy to meet with people to go over that and make sure that they're taken care of too. So I'm going to go ahead and stop the recording.